Three people crossed $750,000 in the same year. Same number, same market, same 5 years in front of them. 5 years later, one of them has $1.1 million. One has $940,000, which is worth a lot less than it sounds. And one has $652,000, which is less than he started with. Nothing separated them except what they did in the first few months after crossing that line. No crash, no lucky stock, no inheritance. And here's the part that should get your attention. All three of them felt like they were being responsible at the time. Not one of them thought they were making a mistake. Now, a word about the title, because I don't do fear bait here. You are probably not going to lose everything. That's not what happens to people. But losing a third of it in a single event you never saw coming happens constantly to careful people who did everything else right. The reason it happens at this exact point is that when you cross into serious money, the thing most likely to hurt you completely changes, and almost nobody changes their behavior to match. I'm Mike, a regular guy who reached financial freedom on an ordinary income. I'm not a financial advisor, so take this as plain English education and run your own situation past a professional. This channel is where I explain the money stuff nobody ever sat us down and explained, the way I'd explain it to a friend across the kitchen table. If that's your thing, hit subscribe. Let me explain why $750,000 is a real line and not a made-up one. Because the arithmetic shifts underneath you and nobody sends a notice. Think about the same ordinary event. A 10% drop in the market at 3 different points in your life. When you had $10,000 saved, a 10% drop cost you $1,000. Annoying, and you replaced it in a few months. At $100,000, that same drop cost you $10,000. That one stings, but a year or two of disciplined saving fixes it. At $750,000, the identical drop costs you $75,000, which for most American workers is more than an entire year of take-home pay. And a 20% drop, which happens every handful of years, is $150,000. Nothing about your behavior changed. The number did. You spent 30 years digging this pile with a shovel, and somewhere along the way, the pile got bigger than the shovel. There's a second thing that changes at this level, and it's the one nobody says out loud. The median American household has a net worth of about $193,000. You have roughly 4 times that. But the threshold for the top 10% is around $1.9 million. So you are nowhere near the world where people have a team. Genuinely wealthy families have an attorney, an insurance specialist, and an estate lawyer whose whole job is making sure one bad day never takes a piece of the pile. You have a 401k statement and good intentions. Real money with no infrastructure around it is the most exposed position in American personal finance. And it's exactly where you're standing the day you cross $750,000. So let me introduce the 3 people because each one made a different reasonable-sounding decision. The first is Neil. He's 56, and when he added it all up at the kitchen table and got to $760,000, what he felt was permission. 30 years of being careful, and the number finally looked like an achievement. So he loosened up. Nothing crazy, no boat, just a slightly nicer everything. A bigger car payment, a kitchen he'd been putting off, a couple of real trips. His monthly spending rose by about $2,000, which meant the $24,000 a year he used to invest stopped going in. And because Neil now thought of himself as a man who had arrived, he never asked the question that mattered, which is what could take this away from me. His auto policy still carried the same $250,000 liability limit it had when he was 34 and owned nothing. His beneficiary form still listed his late mother on a 401k from a job he left in 1998. He had no umbrella policy because nobody had ever mentioned one to him. The second is Faye. She's 61, and she reacted to $750,000 in the opposite direction. The number frightened her. She had watched her parents lose a third of everything in 2008 and swore she would never let that happen to her. So she moved $600,000 into a savings account paying 4% and left $150,000 invested. 4% felt like a real return, the balance never went down, and she slept well. The third is Kendra. She's 58, and she treated crossing $750,000 as a change of job description rather than a finish line. She kept her money invested, kept adding about $1,000 a month. Then she spent one Saturday afternoon doing 5 unglamorous things. And that afternoon turns out to be the entire difference in this video. Let's take Neil first, because what happened to him is the thing people never planned for. 18 months after he crossed the line, his wife pulled into an intersection on a wet morning and misjudged a light. A man in the other car ended up with a permanent spinal injury. There was no malice in it. It was 4 seconds of an ordinary Tuesday. The settlement landed far above the $250,000 limit on their auto policy, and the difference had to come from somewhere. It came out of the brokerage account and the equity in the house, about $400,000 of it. I want to be honest about base rates, because that's exactly why this risk gets ignored. Most people never face a judgment like this. It probably won't happen to you. That is precisely why almost nobody buys the protection, and precisely why it's devastating when it lands. Here's what Neil didn't know. Your auto policy typically caps liability around $250,000 or $300,000, and your homeowner's policy sits in the same range. Those limits were set back when you had nothing, and nobody calls to tell you they've become inadequate. Meanwhile, judgments have grown a lot. Verdicts above $10 million used to be rare, and the median for that category climbed from roughly $21 million in 2020 to about $44 million in 2023. While the number of verdicts topping $100 million nearly doubled in a single year. The fix is an umbrella policy which sits on top of your auto and home coverage and takes over when those limits run out. In 2026, $1 million of it runs somewhere between $150 and $550 a year, with most families landing near 380 times. A few $100s a year to protect $750,000. I don't know of a better ratio anywhere in personal finance. Buy at least as much as your net worth. Expect the insurer to require certain minimums on your underlying policies first, and know that it generally excludes business activity. Most importantly, you cannot buy it after something happens. The day a claim is filed, your limits are frozen at whatever you happen to have that morning. One accurate detail that matters, and most videos get it wrong. Money inside a workplace plan like a 401k has strong federal protection from creditors, and IRAs get protection that varies by state. So, in a lawsuit, the exposed money is usually your brokerage account, your savings, your home equity, and your future wages, which is exactly what Neil lost. That protection is a genuine comfort, and it is not a plan. Now Faye, whose mistake was the quietest of the three, 4% on $600,000 sounds like a real return, and in raw dollars it is. But inflation has been running near 3%, which means her actual gain in purchasing power is close to 1% a year, while the invested world compounds at closer to 7%. 5 years in, her total sits around $940,000 on paper. Measured in what that money actually buys, it's more like $8,000–11,000. She hasn't lost a single dollar. She has fallen a long way behind, and nothing on her statement ever told her. But the more dangerous thing that happened to Faye is the part I really want you to hear. 8 months in, she got a call about an investment paying 9%, guaranteed and fully secured. It was well presented. The man was patient and warm, and she had been quietly bothered for months that her safe money wasn't doing much. She came within a day of wiring $200,000. That combination, a frightened saver sitting on cash that isn't performing, is the most targeted profile in America right now. Look at what the FBI actually reported for 2025. Americans 60 and older filed just over 201,000 complaints and reported losses of $7.75 billion, which was up 59% in a single year. The average loss was about $38,500, and more than 12,400 of those people each lost over $100,000. The largest category by far was investment fraud at $3.5 billion, nearly double the year before. The FBI also logged more than 22,000 complaints involving artificial intelligence, including voice cloning good enough to imitate a grandchild convincingly enough to fool the person who raised them. What saved Faye was not being clever, because these operations fool sophisticated professionals every week. She was rescued by a rule her daughter had made her promise to follow, and it's the only defense that reliably works. No financial decision gets made the same day it's presented, no matter who is asking or how good the reason sounds. A legitimate opportunity survives 24 hours. A fraud almost never does because urgency is the entire mechanism. The companion rule is to verify on a number you looked up yourself. If your bank, the IRS, Medicare, or your own grandchild contacts you about money, hang up and call back on a number you found independently. And no real institution will ever ask to be paid in cryptocurrency, gift cards, or a wire to a personal account. That request by itself is the whole answer. Two more things that cost nothing and take an evening. Freeze your credit at all three bureaus, which federal law has made free since 2018, and turn on two-factor authentication at every bank and brokerage you use. At $750,000, the accounts holding your life's work are often still guarded by a password you picked years ago and reused somewhere else. Which brings us to Kendra, and that Saturday afternoon. She bought an umbrella policy for about $380 a year and set the coverage above her net worth. She logged into every retirement account and insurance policy and fixed the beneficiary forms, which matters more than people realize, because that form legally overrides your will. An old account naming a dead parent or a former spouse goes to that person, and your family cannot undo it. At $60,000, that's painful. At $750,000, it's life-altering for the people you love. She got a basic will, a durable power of attorney, and a healthcare directive, which together run a few hundred to maybe $1,500 with an attorney and keep her husband from having to petition a court just to manage accounts with her name on them. She looked hard at concentration, because she'd held company stock for 19 years and it had quietly grown into almost a third of her net worth. That's a position where one company's bad quarter can take your job and half your savings in the same week. She sold it down gradually, watching the tax consequences as she went, into something broad and boring, with a rule that no single stock goes above about 10%, and she named her long-term care plan out loud, which almost nobody does. Medicare does not pay for long-term care. It covers medical treatment and a short stretch of skilled nursing after a hospital stay, and then it stops. A skilled nursing facility runs around $9,700 a month in 2026, and a couple of years of that takes a serious bite out of $750,000. There are only three honest answers, which are to insure it, to earmark a specific piece of your money for it, or to plan on spending down and relying on Medicaid with the real limits that come with it. Home equity is what many families end up using, and that's completely legitimate, as long as it's the plan instead of the surprise. What fails is leaving it unnamed, because a risk with no size attached to it can quietly eat everything. There's one more item on Kendra's list, and it breaks the pattern because it isn't an event at all. It's a leak that finally got big enough to see. If you're paying 1% a year for someone to manage your money, that won $600 back when you had $60,000, which isn't worth losing sleep over. On $750,000, it's $7,500 every single year, in good markets and bad. I'm not telling you to fire anyone, because good advice is worth paying for. I'm telling you to find out what you pay as a dollar figure instead of a percentage, and then decide whether what you get back is worth that number. Most people at this level have never once seen it written in dollars, and that is not an accident. So here they are, 5 years on from the same starting line. Kendra has about $112 million from staying invested and adding $1,000 a month. Faye has about $940,000 on paper, worth roughly $811,000 in what it actually buys. And she still has most of it, only because she waited 24 hours on a phone call. Neil crossed $1 million on paper before the accident and came out the other side around $652,000. With fewer working years left to rebuild it, notice what actually separated them. It wasn't returns or skill, and it certainly wasn't luck in the market, since all three got the same market. Every bit of that gap came from what they did about risks that had nothing to do with picking investments. The pile is bigger than the shovel. That's the whole reason this number deserves a moment of attention, and it points at a change most people never make. For 30 years, your job title was earner. Everything pushed in one direction, which was to add more. Starting somewhere around this number, a large part of the job quietly becomes guardian. And guarding is a completely different skill from earning. It's unglamorous, it shows no visible progress, and nothing about crossing the line makes it feel urgent on the day it happens. And this applies well below $750,000, which is why I'd keep watching even if that number is years away for you. The real switch point isn't a specific dollar amount. It's the moment your portfolio can move more in a bad month than you could replace in a year of saving. For some people, that arrives at $400,000, for others at $1 million, depending on income and expenses. What matters is noticing the day it arrives, because the advice that got you there stops being enough the moment it does. So here's your one job after this video, and it takes about 10 minutes. Pull up your auto insurance and find the liability limit, usually written as something like 250 over 500. Compare that number to your actual net worth. If your net worth is bigger, call your agent tomorrow and ask what an umbrella policy would cost. Then, while you have the accounts open in front of you, update one beneficiary form. Neil's $400 a year wasn't the part that haunted him afterward. It was that in 30 years of being careful with money, not one person had ever mentioned it to him. The pile is bigger than the shovel now, so give it one afternoon of guarding. If this was useful, hit subscribe. This is what I do every week, plain English, nothing to sell you. Next video. I'm finally covering the account that quietly beats every other one in the tax code, and almost nobody uses it the way it was designed. It's the health savings account, the only account that can be tax-free 3 separate ways: going in, growing, and coming out. Most people drain it every year on small pharmacy bills instead of letting it compound into a 6-figure tax-free medical fund. The rules change significantly at 65, and there's a timing mistake around Medicare that can lock you out of it permanently. I'll walk through all of it. I'm Mike. I'll see you in the next one.